Let's ask Rick Rieder. He is BlackRock's CIO of Global Fixed Income, also the head of the Global Allocation Team. In other words, he covers it all. And he's here with me at Post 9. Welcome back. It's good to see you.
Yeah, thanks for having me.
All right, so we're coming off an incredible month. I mean, bonds had their best month since the 80s. Stocks have been ripping. What's your current view of the markets?
So listen, I mean, there are a couple of things that make sense, a couple of things I think are a little bit askew. The first one is inflation is coming down. I mean, the data is clear on inflation. I mean, I was looking at core CPI x shelter, which shelter comes down with a lag, but it's running at 1.5%. You look at, 6-month moving average of inflation, core CPI is running in low twos. So listen, I think core PCE quarter over quarter is 2.4. So I think it's real in terms of inflation coming down. The narrative of the economy falling off a cliff, that we're moving into a recession and the Fed's got to start cutting. In fact, we were pricing in a cut in January, which was in the markets, which is absurd. Mm-hmm. Listen, I think that's maybe a bit presumptuous. And I don't think the economy's fallen off a cliff. I don't believe we're going to a significant recession. So I think the pullback you saw today, particularly in the front end of the yield curve, I think makes some sense.
So you're a believer. You're a believer in the soft landing scenario that inflation is going to continue to come down.
Yes.
And the economy is going to hang in there enough.
So I don't even, I know I said it on your show before. I don't even know about this whole landing concept anymore. I mean, I think that you have an economy that's much more stable than people think. I think we're moderating from a period of extraordinary growth. You think about nominal GDP. A couple of years ago was 11. Last year was 7. I think we are normalizing from, what is extraordinary monetary, extraordinary fiscal policy, and we're just normalizing. Listen, we've got next year, we've got real GDP running at about 1.5 with inflation running about 2.5. That's a normal economy. So I'm not, I think the world focuses way too much on surveys, and surveys get nervous much more. So if you look at, I know you talk about it all the time, a number of companies are talking about actually a bottoming, which I think is a bit over the top. But you look at inventory levels. We're looking today, inventory levels for a number of companies have come down quite a bit. So anyway, I'm pretty sanguine about slowing, but not excessive slowdown.
Is the Fed done hiking?
I think yes. I mean, they are done. The question is, when do they start evolving the narrative? Real rates, if you think about a funds rate, 5.25, 5.5, with inflation moving into the twos, the real rate is too high. And so I think the Fed's got to start cutting. I think the market's ahead of itself in March. We were pricing on Friday, we were pricing 2/3 chance you'd cut in March. I think that's over the top. But I think in May, June, listen, I think they'll start cutting. I think they'll start doing something like 25 basis point cuts to get the real rate down to what is the level that, by the way, that would be restrictive. And it's just too restrictive today.
So you said the narrative is evolving. Waller, did he play a role in evolving it by suggesting that you could, in fact, have those rate cuts? Steve Leisman suggested he said the quiet part out loud. Now, he's not the chairman, but nonetheless, his view was provocative, and it did move the market.
So he's very influential. He's very thoughtful, and he's very model-oriented. And so he's been a hawk because he was right to be a hawk because inflation was high and employment was operating at a breakneck pace. All of a sudden, he cited something as the quits rate coming down, the unemployment, the quits, some of the slack in the labor force is starting to build. So I think he's been sincere. He's being sincere relative to an economy that's moderating and inflation that is really coming down. So I think, and I didn't hear Steve say that, but I think it's right. I think he was exactly as you would think he would be, but he just said it. And the markets reacted to that.
I mean, the implication is that they cut because they can.
Correct.
Not because they have to.
Yeah, and by the way, now the balance is much more two-way. And I think it's a really big deal for markets. If you now have a Fed that can respond in the way of cuts, now you've got, when you think about what interest rates are, can they be a hedge? Can they be ballast in your portfolio? As opposed to, we've lived in this environment where rates are going up, you're going to have negative return in fixed income. Very different paradigm, not just for the rates market, but for all markets.